happening.
Nice. Welcome, welcome everybody. Welcome to tonight's webinar. We're excited to have you. Let's see here. I want to see those of you that we know, we recognize. We have a lot of our current investors that are joining us tonight. Gary, welcome. We love Gary. He's a current investor. Chip, man, we've got a ton. Desiree, this is awesome. We'll give you guys a couple minutes to trickle on in. We're excited about tonight. I'll kind of explain a little bit about who we are. So we are MF Capital Partners. We focus on the acquisition and management of opportunistic and value-add multifamily properties. And we're primarily located in the South Central region. We currently have a little over 2,700 units with a portfolio of just below 300 million. Now, what is it that we do? Well, we reposition well-located assets in emerging markets to protect investor capital like yours and provide high yield returns. And y'all, tonight, we're gonna tell you how we were able to do that. We're gonna let you guys have a little insider peek into how our incredible team has gotten to where we are today. So we know that, excuse me, we know that there are some of you that wonder what the heck it is that we as operators actually do with your investment. So tonight, we're actually gonna go over the specific things that we do that differ from some of the other operators. So these differentials consistently are able to get our investors the highest returns possible. And obviously that's our focus, but not that easy. There's a lot that goes into play, which is why we have the incredible Lindsay Daniels. She's this gorgeous girl that we have tonight. She is our asset manager, and she's going to be dissecting two different properties that are actually a part of the MF Akahi Fund, which is probably why a lot of you heard about tonight's webinar. So the fund, the Akahi Fund, obviously tonight's webinar is about how we really take down the acquisition of the properties that fund the MF Akahi Fund. So I'll tell you guys a little bit about the fund. We have 4 properties right now that we have acquired. We have a 5th property that we are under contract. We are set to close next week, which will be 5 properties inside this fund. This fund, we have 2 different classes, a couple different return metrics, but essentially it's a 6 to 8% preferred return, and then also a 16 to 20% annual rate of return on the back end. So again, that's probably why y'all are here, but the 2 properties that we're gonna really focus on the most tonight, in addition to all the other items, but it will be Coventry and Dover Point. And we're gonna show you the many different ways that we put your money to work harder and smarter, obviously, so that you guys can get the highest and fastest returns. So just so y'all know, we are gonna keep this presentation to about 30 minutes, and we're gonna allow for some time for questions at the end. So stay tuned. If you have questions, please feel free to put it in the chat or the Q&A. Either one, we have our team manning both areas so that we can make sure and get you guys taken care of. But with all of that being said, let me talk about this girl, this woman. I keep saying girl, but y'all, she's a woman, okay? She is amazing. This is Lindsay Daniels. Some of you already know her. You love her. She has 19 years in operations and asset management. Y'all, she does not look like she could possibly have 19 years, right? But she does. She actually started with a company when they only had 4,500 units, and she helped get that company to 95,000 units. So she was in leasing, due diligence, and everything in between. And she worked her way up to the VP of the 8th largest property management company in the United States. So obviously that's pretty darn impressive, but this is the excellence and the experience that Lindsay brings to MF Capital Partners. And I, for one, am so excited to have her here, willing and able to talk to our investors and really give this behind the scenes advanced investor webinar. So we will turn it over to Lindsay. and let you spit your wisdom.
Okay. Thank you, Melissa, and for that introduction. And I would just like to thank all of the current investors that we have and for trusting us with your your money, and that we're going to, place it and do it in a way that we are helping create the generational wealth, for your family through this Akahi fund. And to those that, are just getting to know us, welcome. Hopefully we create some value in our presentation that makes you feel comfortable with who we are and, our work ethic and what we represent. So thank you for this opportunity. The first thing that I would like to kind of start out with, because I'll try to squeeze a lot into a short period of time, I suppose. But
wait, is there really that much information?
No, yeah.
Just a little.
Just a little bit. But I oversee, both the asset management and acquisitions with MFCP, and the teams that we have on both sides. So I'm going to start kind of with the acquisitions process first before I get into, Dover and Coventry and the more property detail specific is with the acquisition process, what we do to get to the point of getting a property over the finish line, there's a lot that goes into it. We don't blindly or just randomly, go into these assets that we choose that are in the Akahi fund. We go through a very, very diligent process. I mean, they call it due diligence for a reason, right? But you have to actually go through and look at the documents and dissect them. And I feel like sometimes I'm probably that person that is I don't want to say like the fun sucker, but it's almost like, are you trying to kill the deal or what are you doing? And for me, it's like, I just want to ask all the questions. Like, I want to find out, like, if something's going to go wrong, like, what's that going to be? And
Lindsay, that's a perfect part to just identify that this is why it takes a team, y'all. We've got a few of us that are the ones who are going to pick the deal apart. And then there are a few others that are optimistic and creative and outside of the box thinkers. And that is why you need to pick the litter and really surround yourself with incredible teams like Lindsay.
Well, like you said, the team effort, we all bring a different vision or to help think outside of the box. I know I can get tunnel vision sometimes. So it's, how are we, what's the solution? And I know Tyler's always talking about, regardless of the property, every property has its thing. Every single one does. So what's the solution, or how do we take this opportunity to bring value, to make money for our investors and to bring value to those communities? So I would say for every deal that makes it over the finish line, we've gone through at least 10 properties that we've said no to, or that we've gone through the underwriting and the back and forth at the round table and decided, that's just not going to be the best placement of money. So that's kind of the first place where we start. The business plan can change and pivot from time to time. And just one more reason why I'm very excited about the Akahi fund, because doing the fund brings the diversity, with the different properties and just kind of our I just lost the word, basically the guidelines. Criteria, there you go, criteria of the deals that we choose for the portfolio, which with that, I'll kind of go into Dover and Coventry. So talk about two properties in the same Akahi fund within 3 miles of each other that we will absolutely operate differently. There's a lot of similarities, but property management is just so not cookie cutter. I can honestly say I don't think I've had 2 days alike in my career, but probably why I love it so much, just the changes. Couple of things that we start with is when we go into the property, of course, we're looking at what's the upside. How can we push rents? How can we, what's going to be the business plan behind each deal? That said, if we're looking at rent increases and we're going to go in and we're going to renovate apartments, we start the deal and I realize, we're getting these rents just by showing up. The rents that we wanted, we're just getting. I may stop, talk to the team and say, we should just with the wind at our back, let's take advantage of this. Let's not spend the money that we don't have to right now. We'll get that on the rebound once we've kind of, gone with that flow. And then we come in and we use that capital. So we go into it with a business plan, but we are absolutely going to make changes along the way that are going to be in the financial best interest of investors and the fund that we have at hand. So a couple different things with that is not just looking at the rent, if you will. There's so many other opportunities that get missed along the way.
Wait, Lindsay, I'm going to stop you.
Mm-hmm.
I just have a question.
Uh-huh.
I want to know, so all of you guys that are on tonight, I want to know how many of you, or maybe not how many of you, what do you think is the most important thing that Lindsay focuses on when we acquire a property? I want to hear what you guys think is her focus. Market, Mary, that's a great answer. Due diligence, Lacey says due diligence. Value add, asset reposition, due diligence. Absolutely. Risk analysis, you guys are NOI, plan, due diligence, acquisition, values. Yep, you guys are, that's awesome. There's so much that goes into this. And I think that Lindsay does not give herself the credit. So I am going to absolutely stop her and remind you guys that this woman is going a million miles an hour, trying to make sure that all of these checkboxes are checked, but that's because she has the experience to do so. So what would you say, Lindsay, as I know you were just about to dive in, but what do you think is the most important?
Just the missed opportunities, typically by the previous ownership and previous management. I think people get very comfortable. I don't want to say like status quo, but the rents are typically, they are the easier thing to go in and raise rents. And I think that's what the majority of operators do. And you should, that's part of the game. But what about the other income? What about parking? What about charging back within the realm of the law, 100% of what you can on the expenses of what we pay on the properties for utilities? And just really quickly, I'm going to give you an example of a study we did on one of the properties in our portfolio. They currently spend about $22,000 a month in water, sewer, trash. This property is in Texas, so you can only charge back 75%. Upon acquisition, the company was charging a flat fee. I think it was $35. So sorry, I'll try to make a long story short. But $35 across the board on this size of community, they were collecting just under $3,000 a month. But the cost is over 20. We had a third-party vendor come in, do the analysis, and we realized that once we start charging back the full amount we can within the realm of the law, that is not abnormal at all, that would put us monthly at $14,000 on average in collections. It's like $136,000 annually would be that variance or the delta. Like what that does to your bottom line in the NOI by just one small change, it's huge. And so a lot of these properties that we do take on, they're not charging back what they can. So something that...
sorry, I don't mean to cut you off, but I mean, you guys, how many of you are nervous or curious about this market and what's going on with interest rates, and will we have the ability to increase rents? I mean, I know that I talk to a lot of you with those concerns. How many of you have that concern? I want to see it in the chat. I want to see those of you that are worried about the market conditions right now.
I think it's also, but if they're not worried about it,
yep.
Because it truly is. I was in the industry. I was in this same space in 2008, and that's when I saw just so many of our clients, and the growth start to really happen. And so, we're in a little better position this time without the bad loans, but we're so far behind on what's available in the housing market. And so apartments, 2-bedroom heavy, 3-bedroom heavy, people, roommates, downsizing, like we're in a great space. And I do get very excited about it. not what's going on in the economy, but what it does for our space. It's a very positive, it's an exciting time. You know, property values are either leveling off or going down, which that gives us a really good position. I know Tyler's talked about that, you know, in previous webinars, and it really is exciting. And for me, and what I get to see and what we're pushing, but to kind of go back towards those two properties that are in the Akahi fund, and kind of differences between the two of them, you know, the example I just gave on Rubs, neither of those properties had them implemented like that. So out of the gate, day one, both implemented. Every single property in this fund will absolutely start with at least that one metric that is going to, you know, out of the gate. That's not even a question if we're going to do that or not. Then there's other things like, you know, we may not have put in our initial business plan to add washers and dryers, but they have hookups. Why am I going to pay or refer them to go pay a vendor $50 when we can spend $800 and charge back the resident for that $50 a month? I mean, the ROI on that is, I mean, it's almost like cheating, you know? So there's just so many different opportunities that I do feel a lot of operators don't look for, charging back CAM fees. And at the end of the day, it also makes our residents more conscious of what they're spending and their utilities and turning off lights and managing energy, reevaluating contracts often, which kind of leads into like who we partner with, right? So management companies and who we hire and vet, because I don't ever want it to be like a robot. It's like, well, the market rents at $785, so go get $785. You know, every day it needs to be a conversation of supply and demand. If we only have one left, why not charge $815? Like, why not try to get that higher rent? It doesn't have to be, you know, just the baseline. So,
and I just want to point out that, you guys, this is the exact definition of experience. Because truly, your beginning operators, they would do those things. They would do the bare minimum or the cookie cutter because that's what they have been taught. But when you have this much experience between Tyler and Ryan and Lindsay and all of us together, you have the experience of really identifying, hey, if we're not concerned if we can't raise rents or if there's an issue with that, because we have the experience to find those other operators, find those other income opportunities, and to know to look outside of the box. And then, like Lindsay said, how important it is to vet the property management companies. We have the experience to know of that. So obviously we're not naive. We know you guys have many opportunities to invest and put your money to work. And keep those in mind. Remember that who you're investing in, if they don't have that kind of experience, then they're not going to be doing these things.
I feel bad to a degree, but you know, you're talking to a property on a weekly call. You know, we have weekly calls with properties and they're like, if we rent this many more, we're going to be 100%. And I just kind of am like, well, I just want you, like, you're not going to get a great job from me if you hit 100%. My question is going to be like, why did you rent the last one so low? So it's making sure that it's a balancing act. It is truly a fun numbers game, in my opinion.
It's a chess match.
It is, but it's always changing, and it's being better than you were yesterday and watching those numbers. And it's like, once we beat that budget, like, I'm going to still look to that for my expense guideline, but now the income, it's a whole new level of what the expectation is, and just, you know, consistently moving the bar. And so we have to have those good relationships with the management, make sure goals are aligned. And so it's a lot of work, but it's great work and it's a lot of fun. It's exciting to see the changes. Every owner has a different business plan. So what works on one property and pushing those rents, the next person's loan or the way their structure is going to enable them to then go in, or like us going in and buying a new property and then take it to the next level. It's this continuous game of growth and, you know, generating revenue. But it goes beyond generating revenue as well. You have to make sure that we're mitigating risk, that we are doing inspections, that we're making sure there's no life safety issues on the property. And if things come up, that they're taken care of, you know, right away. It's a big part. And there are operators that don't focus on that. And it needs to be, big, keeping up our properties as well. So those are just a few items of what we focus on.
So when you vet a property management company, do you just Google property management company in Waco, Texas, and you call the first one up and you're like, hey, listen, I got a job for you?
No, we definitely, I don't ever, we don't go with just one company. You want to keep people honest. You want to also have that friendly competition between the companies to, make sure everybody's still, on pace and pushing forward. But there is a lot that goes into, vetting the different companies that we have out there. What are they doing? Do they have programs in place that make sure that every vendor that steps on property has the proper insurance and that they're tracking that it's not expiring? Heaven forbid something happen. We don't ever want somebody on our property working for us that isn't, working within the realm of the law and having, the proper insurance and making sure that everybody's just following the rules, so to speak. I am definitely by the book type when it comes to that. I want to make sure that we have policies and procedures in place that protect the investment for our investors and, the asset as a whole and our residents. And unfortunately, we've seen a couple of companies go where I'll watch things and it's sometimes surprising, that those things are missed. And so that's something that we definitely focus on. And it's part of our business plan is who we're aligning our partnerships with to make sure that we are, producing and providing the best that we can for our residents and our investors.
All right, I have a quick question that I want to answer. So Roberto said, yes, the market is very concerning regarding investments at this time. Is it safe to make a large investment? Absolutely. But I will advise you, this is really when, it's always crucial. Really, you're not investing in the property, you're investing in the management team. But now more than ever, you need to rely on experience. Now, you want to work with operators who have this kind of knowledge, like we've talked about, and the ability to really vet property management companies. And like Lindsay is talking about, know the other opportunities to increase income, not just through rent. There are so many other ways. So as you're vetting your investments, remember that now more than ever is the time to be critical of those operators. So Roberto, absolutely, we would love to have you a part of the fund. I know that Tasha has dropped a couple links if it's something that you're interested in. I know, Tasha, if you want to put in a link for scheduling phone calls. We have an investor relations team that shows that you have the ability to call and really ask questions and really dive into some of your concerns. So she'll drop the link to make sure that you guys can see, exactly what, or not see, just so that you guys can actually understand, get a piece of the team and who it is that you are working with. So absolutely, the answer is yes. The long version, the short version, yes. So Lindsay, one more question. Well, actually I have a lot of questions. Investors have some awesome questions here. Bob asks, what are the classes of the 4 and the potential 5th property within the fund?
So those properties we have, I know quite a few, these ones so far have been in the Texas market. And so we are currently looking outside of Texas. We are looking into more of the, they're like the Central Florida area is where we're looking into properties. And I couldn't honestly tell you how many I've been going through diligently and what comes across my desk from brokers that we have relationships with. And that's one thing I would say too, Melissa, is we've spent quite a bit of time really, getting these relationships with, Berkadia, CBRE. And so we have, better qualified or deals that fall in our criteria, which are, we're looking for B properties in B markets, not as much the C at this time. 100 units plus is what we're looking at. There's going to be some with the value add, but there's other that are going to be more just that maintaining and the consistent, cash flow on those. 1990s and newer is part of that criteria. And I think that was it, 1990s, B, 100 units plus. And then into the, I would call it the, I don't want to call it the, like my brain just like stopped on me for a second. I'm so sorry. It's going to be into, you know, we're looking in Missouri, Kansas. There's like 5 different areas that we are really kind of honing in on that continue to show the positive trends and the positive growth. Nothing really East Coast and not on the West either right now.
So you talked a little bit about Coventry and Dover Point. Mm-hmm. John, who's on the webinar, said that he is familiar with Dover Point and was wondering if that property specifically is part of the current offerings. And John, yes.
Yes.
The fund is acquiring Dover Point. So if you're investing in the fund, oh, go ahead.
Oh, I was just going to say, no, we closed on Dover. So Coventry and Dover are currently part of the Akahi fund. It's Glenwood that is the one that's coming online still, but yeah, Dover is well on its way.
It's awesome, John. I love that you are familiar with that property. I love that. And then I have some other questions, but Lindsay,
no,
I don't want to.
Let's go through questions.
Okay, I'll let you answer a couple of these. This one is, how is equity percentage calculated per 100,000? So the way that your equity is divided is based off of the raise amount, and then you receive you do the investment amount divided by the raise amount, and then that determines your overall ownership. Now, our investors on the LP side receive 70%. So if you times that number by 70%, then that would get your equity percentage of the property. And then the other question is, can you talk about the timeline from initial investment to exit and disposition of fund assets?
Well, that really depends. As far as the position of the property, because I mean, the property or the fund that the portfolio that we sold in South Carolina, you know, we didn't have intentions at that point of actually selling, but, you know, someone off market, you know, comes to the table. So each property, although it's the fund, and correct me if I'm speaking out of terms here, but each property we go in, you know, because it's got a different loan with, you know, it could have a different lender on it. But for the most part, the game plan is going to be, you know, the same on the whole time on those. However, you know, things can change. It is truly an ever-changing atmosphere because there is so much going on, or we don't know, you know, who may want to have an asset in their portfolio. So I'm probably not the best one to answer that, like in the best fashion, I suppose. I more keep my head down, focused on just driving the revenues and mitigating risk versus like what that timeline is like to, you know, sell or when the change is going to happen. I'm more focused on.
That's a great point. James, we have each one of us within the company, each part of our team has a different position, a different focus. And that's really Tyler's focus. Tyler is constantly focused on the market cycles and understanding, is it a good time to sell? When he's usually projecting far in advance. So Lindsay focuses more on the now, and Tyler focuses more on, okay, we're projecting a 3 to 5 year hold. Would it be better? We're now in year 2, so we need to begin preparing for exit. Are we going to refinance? Are we going to exit? So that's really something that Tyler determines. So right now, we're just acquiring these properties within the fund. So they're each, you know, a month or two new. So we're in phase 1 on all of these properties that we've closed on already. So typically, I mean, as far as timeline, I think if you're talking of like the nitty gritty, initial acquisition, Lindsay, what would you say, 45 to 60 days till the time you close? That's longest. Usually it's a little bit sooner than that, especially with a fund, because the liquidity is there and ready. And I would say, again, it's, you know, at least by year 2, we begin looking at exiting. So like Lindsay said, we each have a role, and that's Tyler's. He geeks out on that information, y'all, which is great.
Right.
We want him to.
Right. My side's more keep your head down, keep plugging away, generate the revenue. And
I love that. And so Gary asked a good question as well. He said, good evening. Are you using the same property management company on all properties in the fund?
No, we're not. We have two different management companies that we're using, and have used on prior properties that we've owned or still own that are outside of the Akahi fund, that have proven to be good operators, keep the needle moving. We're aligned, they align their goals with what we see, and we operate the same. And I personally don't have any desire to ever just say I'm going to go all in with one company, or that there's one that's the best. I am all about competition. I try to keep it friendly competition, but I like to have multiple engaged to be able to watch and make sure that, if they're here, why are we here and why are they not here? And get them to kind of continuously push forward. Or it's a good way to, if there's an unfortunate situation, to realize maybe we have an operator that isn't the best and we should make a change.
So Lindsay, if you had to say, I know that list is huge. I've seen her list, y'all. It's quite long of what she requires for property management companies. So if you had to narrow that down to your top 3 items, what would you say your top 3 items are really your decision makers on whether you would go with that company? Or can you narrow it down
to
3?
To a degree I can, because I want to make sure that we're using companies that their goals internally and what they're, paying their people is based on goals and meeting and exceeding expectations. Anybody can just manage and have a property plug along. I don't work well with just plugging along. Like, what is the benchmark? How are you getting there? And once you get there, what's the next goal and what are we going to do to get there? And that's where, we are working with them, but they have to be a very driven and goal benchmark oriented company. They need to have requirements where they don't allow their regionals to have a portfolio over a certain size, because I want them engaged and, boots on the ground, since I'm not there at every property type of thing, nor do I want to be. It's why we hire a third party. It's my job, checks and balances and generate, other opportunities with revenues. And then a company that's going to take ownership and do what they can to mitigate risk, like I said, in inspections and keep upkeep of the property, and build community and focus on resident retention. So I guess it was 4, but if I had to narrow it, that's going to be the biggest thing.
That's awesome. Okay, a couple more questions. Are you okay if we answer just a couple more?
Yeah.
Okay, Mohammed says, is there an opportunity for folks who could to be KP or a loan guarantor? No, there at this point, the only opportunities we have are as limited partners or as passive investors. So we take care of all of the guaranteeing the loan, making sure that we're making all the correct decisions. That's what our experience benefits us for. So only opportunities right now are passive investors. There are a couple other ones, if you're okay if I answer.
Yeah, of course.
Let me just grab here. What rent increases do you use in your underwriting for most of these properties?
That depends on the property. It depends on the unit count. It depends on the size and the location. I think we typically go into it a little conservative compared to what we end up getting. I think anywhere from the 5 to 8% I would say on average has been what we use in underwriting. We've produced higher than that. I will say, in my opinion, it's just my opinion, it's no fact, is that, with the changing in the economy and the different things that have happened, we may see rents taper off, but that taper off may really just be them going from 15 to 20% down to more of the 3 to 5 to 8%. So I know, long story long, right? But I would say 5 to 8% is what we've used, but achieved quite a bit higher than that on average.
That's awesome. This is the last question that I will, actually there are 2 more and then I'll let you finish your talking about the property. The one question that I have from Octavio is the Akahi fund offering size increasing over time as you reach your raise goals, or how does the distribution of investment participation get dispatched? So that's a great question. Right now, the fund is 30 million. So once we have that, which we have 1.1 million available in that fund. So once that is accounted for and that is completed, then we will go to a second fund. So we will not have an open ending fund. It will close as soon as we get to the 30 million, and then we'll be opening a second. Now that second fund will look extremely similar to the first. It will be the same deal criteria, the same markets that we're looking at. It will just be a different set of diversification with those deals acquired by that fund. And we can walk through all of those details with you if you want to schedule a call in the link that Tasha has dropped. Also, the last question says, do new investors participate in properties already acquired? Absolutely. So like I said, this fund has 1.1 million left. And once that's completely filled, then at that point, you would participate in the new properties that the second fund acquires. So if you're wanting to participate in Coventry or Dover Point, like Lindsay kind of pointed out, those properties, the current fund that's acquiring those two properties specifically, that one only has 1.1 million. So I would suggest that you get your reservation in as fast as you can. And if that doesn't fit your timeline, then you absolutely can be a part of the second one as well.
Sorry, I will jump in really quick, just because I know I really haven't touched, very much on the property specifics. So I will give you just like a little bit of insight from what in the last, month that has happened at Coventry. So, the property, good location, prior ownership. They didn't do a whole lot to invest back into the property to a degree. So like the bricks and the sticks are great. Like there's no, structural issues, anything like that, but it's kind of been just status quo. So they're going in, occupancy reality with delinquencies is more like low 90s, high 80s. So on that property, that is like an out of the gate, like we are going to start the renovations. Rents are very low there for just showing up, honestly, in that market. So there, with the 12 vacancies, let's call it, the game plan is, all right, let's get going. Let's renovate those. Let's increase those rents, like heads on beds, get people in and start that business plan early, along with the exterior projects that we have to do. Whereas Dover, their higher occupancy, closer to 95, that's more of all right, we're going to get aggressive more on the renewals and pushing those rents. And the newcomers coming in, we may renovate one or two, test the waters, but that we have higher occupancy. So it's not, we have more time, I guess, or the ability to really test rents there with current residents even. So both of those, they're 3 miles apart from each other, but it's almost like running two different game plans. But it's exciting either way, because there's just a lot of opportunity that, I don't know, there's kind of, it's weird, but satisfaction, like too, when you go into a property and you clean it up. I mean, sometimes it's a matter of just truly a trash cleanup, you can't change vintage, we can control clean, providing that, like those changes, power washing, what it does for the morale of your residents, the neighborhood. It's a fun process that those things are value add. They're not expensive to do, but nobody's been doing it. So we go in and do those little things that don't cost a lot of money, but we make money just, I guess, showing up in a sense and doing what good operators, in my opinion, should do.
Awesome. Okay, Janine says, do you suggest putting all of your money in one property or splitting between many? So that's a great question. It really depends on your risk assessment. What are your financial goals? This is part of why we went to a fund structure. It's also why our fund structure is modeled after a syndication. We wanted to make sure that we were still allowing our investors to participate in the tax benefits. However, they still have the ability to diversify their risk and be a part of multiple properties instead of only one. So we had investors who had FOMO, and they would see other properties that we had, and then they would be upset that they wanted to be a part of that one as well. And this was one way. Obviously, there were multiple reasons why we went to a fund model, but that was one of them. So one of the perks of splitting between multiple properties is that risk diversification. But it also gives you the ability to really trust in our experience instead of trying to figure out on your own which one is the best property to put my money in. This gives you the ability to say, okay, they're the experts. They understand how to run these properties and really get me my highest returns. So if it was me, that's why we're moving to a fund model, is because that's more what we were interested in ourselves. But also it's because in this market, and Lindsay, you could probably speak more to this, but in this market with everything that's going on right now, having a fund and the liquidity already raised it puts us in a position to really be aggressive. So when we're acquiring certain properties, or we're going to brokers or pocket listings, we have the ability to say, hey, we have the money raised, and we can come in a little bit more aggressive than we could if we would say, hey, we need at least a 60-day close. We're able to get in, do our due diligence, and validate that the money is already there. So there are lots of perks on your end with a fund. You guys get to sit back and make us go bald and really go gray and get these wrinkles trying to determine which ones are best for the fund. So,
and I will say on that note as well, Melissa, is it puts us in a position with brokers and, different companies where they're like, what is going on with, MFCP and what's the Akahi fund? And, they've got, like you're saying, this bulk of money, I would say, 6 months ago, I probably just wouldn't have, Berkadia in Florida just sending me, links of, hey, or like I have one broker that has literally called me like 4 times a day. He's like, are you putting in an offer? Are you putting in an offer? It's because it does change. It changes your ability to, come to the table or play with the big boys, I guess you could say. But
wait, are you and I with the big boys?
Yes, we are. Yes, we are. Or in my mind, we are. But it
absolutely
does, it
the
changes,
big girl.
Right. But it truly changes the way that, brokers are like, you're now on their radar, and they want to make sure that they're sending you listings, or that they've, they have that off market deal that they've told 5 people about, that nobody's supposed to know about. But it does change that. You are now on their list, not they're on my list. And, they are, but it changes.
A game changer.
Game. Mm-hmm.
Yep. Absolutely. Frank put a question in here. He said, what third-party references are available to gain confidence in your firm's integrity? Frank, I love that you asked that question.
Mm-hmm.
I'm a huge advocate for doing your due diligence with your operators. It's what I would suggest to my mom, my grandma, the little old lady down the street. Not that you're the little old lady down the street, but I love that you're wanting to do your due diligence. So if you want to schedule a call, we are more than happy to provide any information that we can to assist in you doing your own due diligence. We love that. So absolutely schedule a call, and our investor relations team can walk through those. And okay, I have another question. We all love taxes. This is a tax question. It says, how does the tax to investors work? Are we getting tax documents for each state that they're in, or an investment, or just one tax document from the fund? So it's from anonymous. So I can't even see who wants to know this question. But this is one of the biggest reasons why we're here. And I know it's probably one of the biggest reasons why y'all are here too. The tax benefits are absolutely something that is a huge priority for us. And it always will be. We have a whole network of high net worth investors who rely on the tax benefits. So that benefit will never change. Within the fund, we will be doing cost segregation studies and really implementing the accelerated bonus depreciation that comes with that. So absolutely anonymous. We will absolutely pass those tax benefits down to you. What we do is we take care of all of that on our end. So not only do we take care of the cost segregation study, but our accountant will take care of really implementing as many tax benefits as we possibly can. We know, since we're passive investors ourselves, how critical that is. So that's something that we are constantly projecting from the very time we begin acquiring a property, throughout the hold, and then obviously during disposition as well. So we will absolutely pass that on to you, but I will need to know your first name. I can't pass on a benefit to a Mr. Anonymous. And then just to answer, I know there's been quite a few people that have asked this, but the minimum amount to invest is 100,000. If you do have amounts less than that, we do have a waiting list that we'd love to have you be on, but it is 100,000. And then really quick, Lindsay, there's another question, and I have accidentally skipped this question, so thank you for putting it back in the chat. So it says, would you talk about main bullet points in management company contracts?
Did you say contrast?
Contracts.
Oh, the management. Oh, the contracts. Okay. So the contracts themselves that we end up going into them with is something that goes back and forth, like with our attorney and the management company's attorneys, and they definitely. It's almost like the same contract, yet it just continues to go back and forth and get redlined like crazy, which is a good thing. Everybody's looking out for their own best interest. We go into it. I would say the bullet points are going to be just the requirements of what they require of us, what we require of them as far as, insurance and keeping everything, registered and legal. We definitely make sure that even if it's a 1-year contract, that we have a 30-day out for no cause. Should something come up or we just don't feel good about things, we can just give that notice, make a change. Knock on wood, I've not in my career had to make but very few changes mid-contract. A couple other big bullet points just goes over the spending, that although, we approve a budget or the underwriting that we implement, there's still dollar amounts that they cannot spend without first getting our approval in writing. Contracts, anything over $5,000 has to have like a full contract, lien waivers signed. It requires them to rebid all contract services at least annually, but on the bigger CapEx items, it's scope of work. It is, bids, apples to apples, multiple people involved making decisions, and then contracts, are signed for all of that work as well. Making sure that really the things that I've gone over tonight, like that I hold them accountable for, that they spell out what the expectation is on both parties, like what they expect of us, what we expect of them, bank accounts, and just the financial obligations that we all have.
I love that. Okay, so I think that we answered all your questions. I mean, I don't want to pat myself on the back, but I kind of want to as well. So make sure we're wrapping up this webinar. Make sure that you put in any question that you have so that we can make sure and utilize Lindsay's time and get your question answered. But just a reminder, if you are interested in investing in the fund and really taking advantage of this incredible experience that Lindsay has, we would love to have you. We have 1.1 million left. And again, we'd love to have you within the fund and really understand how this fund works and how we really manage these properties within there. So again, there's links in the chat. You're more than welcome to follow that to schedule a call with our investor relations team or to set a reservation or view even more just information about the fund. But if you have questions, feel free to put them in the chat. I think, Lindsay, this is pretty impressive. I think you answered all of these questions. And we covered a massive spectrum tonight. We talked about the very beginning of acquiring properties and exiting and in between. Oh, that was intense. There's a lot of information. That's awesome, Lindsay. Awesome. Anything else that you want to include?
No, I mean, I could probably talk forever, but I don't want to talk just to talk. So no, I appreciate the time and the opportunity to try to get part of my brain, I guess, out there on what we do. But it's an incredible team. I've been with the company, 6-7 months. And I think I told Ryan, I'll probably die in my chair here. Like I am like, I can only work, like I have to believe in it, and it's a good place to be. It's a good company and I feel good about it. And yeah, it's exciting. I'm very excited for what we have coming down the line with the Akahi fund. Once that closes in the next one, it's going to be.
And as you guys can see, we're the lucky ones, clearly.
We
are the lucky ones.
Yes, we are.
This is awesome, Lindsay. Thank you so much. Thank you for being willing to really share your knowledge and experience and put up with us for an hour, answering all of these questions. We're so grateful for you. And all of you participating on this webinar, we're incredibly grateful for you guys and the ability that we get to really put your capital to work and our capital. It's an extremely fulfilling job that we have. And we're grateful for you guys allowing us to do that.
Very much
so. Feel free. We love chatting with you. We love continuing that relationship and really making sure that this is something you're excited about as well. So feel free to, again, put some time on our calendar, get to know each member of our team, and really understand how we plan to deploy your capital and get to know us a little bit more. So again, thank you all for enjoying this evening with us, this Wednesday evening. But we hope you guys have a great night. And again, Lindsay, we're so grateful for you. Thank you so much for helping us tonight.
Thank you.
So welcome. We will see you guys later. See you, Gary. See you, Octavio. See you, Carol. Noelle. I'm so glad you guys were able to join. Have a good night, you guys.